Hi everyone, welcome to episode 3 of this Learn on the Go series. I hope you liked the previous two. And in today's episode, I want to talk to you about the evolution of an investor. No, not the theoretical stuff. This will be a bit more practical. And I'm sure you've seen by yourself how your own evolution has been over time. Okay, let's just try it here. Um, yeah, so let's take any company. So let's take Asian Paints. And when we first start, we often start by looking at the price, right? So we say, oh, okay, the price was 3,000. Today it's 2,200. So there's a drop of 33%. So let's go and buy it. Over time, sanity prevails. We understand that there's something called valuation that becomes important. Again, we try and see what's the median P ratio. Where is it right now? We see if it's undervalued, whether it's overvalued. Over time, we start getting a bit more numberish and we start looking at the sales numbers, that how's the growth been. Then we look a little deeper, right? We get into stuff like cash flow analysis, we look at ratios, shareholding patterns, and this evolves into other stuff like what are the promoters doing, whether there's any tailwind, any policy decision that's being taken, who are the competitors coming in, whether there's a certain moat, there's a certain competitive advantage that's available with the company, whether it's got pricing power, who's managing the company, stuff like that. But if I stay within the financials, I think one part which generally gets missed out is generally this one in the middle. Okay, we do understand interest because it's directly linked to the borrowings. We understand depreciation, it's linked to the fixed assets that the company has. We know these are negative entries, so we subtract interest, we subtract depreciation before arriving at the profit before tax. But look at this line here, other income, right? Uh, it's generally something that we assume other income to be something very incidental, might not have an impact on the business. But as you can see here, especially with Asian Paints, while the other income normal, so what's other income normal? This is your regular stuff. So if you have a lot of money in fixed deposits or in marketable securities, liquid funds, these companies keep a lot of money in liquid funds, etc. So the dividend that comes from there, the interest that comes from there, that becomes a part of other income. There's more stuff. So for example, if Asian Paints has lent out one of its residual real estate to some company, okay, it's given it on lease. So the lease payment that comes in, so that becomes a normal income for them. It's not an abnormal income because that land was anyway there, and also that gets added up to this particular number. But what is very interesting here is the exceptional items part. Now, there's always been some exceptional item for Asian Paints throughout the years, and this FY25 it was a bit more. It was 363 crores of exceptional losses that Asian Paints had to book. This was primarily in terms of I think 3 companies were involved here. There was a goodwill impairment that happened. There was also a sale of an asset. I think in Indonesia they had sold off one of their businesses there, and then they had to book a loss of some 80 odd crores. So there were 3 of them, if I remember, and that accumulated to some 363 crores. But we're not there to talk about Asian Paints, but I'll be taking a different company. It's called Deep Industries. I even covered it as a part of the newsletter. And something interesting has happened there, which is what we're going to be looking into. But by the end of this session, I really hope we can get a better appreciation of how important each and every element of the P&L account is and why the understanding of every line item is equally important. We just can't ignore certain line items and say, hey, this is of absolutely no consequence here. Everything is of consequence, and that will be our quest for the day. Okay, let's start with some intros. And Deep Industries has been into support services for the oil and gas industry for the last 30 odd years. Essentially, they are into 5 things: onshore and offshore drilling, which is primarily onshore, but they've entered the offshore services recently. They are India's largest natural gas compression service provider. Deep is also into gas processing, which is an important value add for industry players. It also does gas dehydration, which is the removal of water moisture and heavy hydrocarbons before putting it back into the pipeline. So basically, it cleans up the gas. And finally, the company also offers some project management services like drilling, tubing, cementing, etc. So basically, Deep is positioning itself as a one-stop solutions provider for its clients, which includes the who's who of the Indian oil and gas sectors, So companies like ONGC, Reliance, Keynes, Gujarat Gas, Oil India, and a bunch of others. Okay, let's look at the financials. And basically, liftoff for this company happened in this period. So from FY23 till FY24, so that's a 25% jump in sales and another 35% jump from FY24 to FY25. Correspondingly, the operating profit also improved from 132 to 167, and this year they clocked 231. But when you go deeper down, you really see where the gaps are. Now, for this video, I want to focus on the middle part, especially this one, the other income part. And as you can see here, exceptional loss of 251 crores has been booked. This 251 is not attributable to the entire year. In fact, this has happened in just this last quarter in Q4 of FY25, where this number was booked. And the primary thing that happened, the development that happened in this quarter was a couple of acquisitions that Deep Industries made. So firstly, Deep Industries acquired 100% of Dolphin Shipping, which was under LCLT's corporate insolvency resolution process, which is also called CIRP, CRIP, no, okay, CIRP. And secondly, the company acquired Kandla Energy and Chemicals Limited on the last day of the previous financial year, which was a company into liquidation. Now, because both these companies were distressed, Deep Industries got hold of Dolphin Offshore Shipping and Kandla Energy for a combined of just 9 crore rupees. So basically for 9 crores, they got a hold of all their property, which is the land and machinery. They also received all the inventories in the books of these companies. The receivables were also into Deep Industries. And because these two companies had come out of CIRP and the entire liquidation process, the slate had been wiped completely clean and there were no liabilities on their books. Now, my interest is more on the receivables and the inventory part of the transaction. So let me try and piece together what I think might have happened with this simple illustration. Okay, so we have these two companies. The big company, let's say this represents Deep Industries, while this is your company which is into a liquidation process. And what happens as a transaction is that the bigger company is acquiring the smaller one for a small amount, let's say 1 rupee. And in exchange, all the receivables and inventory in the smaller company goes into the bigger company, which as per our estimate, it's about 10 rupees. So essentially the balance sheet of the bigger company would have these additional inventory and receivables that have been acquired to the tune of 10 rupees. So from a balance sheet perspective, the larger company now has additional inventory and receivables of 10 rupees. So these are nothing but current assets for us. And it's a good thing, right? So on the face of it, it seems like a great deal that you paid 1 rupee for the smaller company and you're getting 10 rupees in return. However, over time, or when the bigger company did an evaluation of these inventories and receivables, it figured out that it's very difficult to recover these any money from this thing. So basically all the inventory is nothing but junk. It's really not, there's no salvage value to it. And with receivables, all the vendors have all run away, and most of it is going to go into bad debts. So it's very difficult to recover this. And what this means is that the management has a choice to make, whether it wants to kind of keep this money in the books. So every year it's going to show 10 rupees is outstanding, and it's going to show 10 rupees outstanding for perpetuity, right? Because there's no way of getting it. Or it can do what any prudent management would do, which is to kind of write off these losses by saying, hey, this money is never going to come to us. So let's just book that loss in this particular quarter, say bye-bye to it, and we can start everything from a clean slate. So that's what Deep actually ended up doing. Booked 250 crores of exceptional losses, which is primarily this inventory and receivables, which it believes are not recoverable. Now, the interesting thing is this loss of 251 crores is not a actual loss per se. It's purely an accounting entry. There was no cash involved in this particular thing, which makes this a very special situation for us to understand. So it's basically an anomaly, and it'll be very interesting to see how the market is actually evaluating this massive drop in profits which have happened for Deep Industries, and whether there's any opportunity there. As to why Deep Industries acquired these companies, well, the first one, which is this Dolphin Offshore Shipping, it has a few tugs which are running in, and these are active tugs. So obviously there are certain operational assets which are available, and Deep Industries feels that it can put them into action very quickly and make a lot of money from it. And as far as Kandla Energy is concerned, it provides an opportunity for Deep Industries to improve its operating margins significantly. They've used the word significantly. I think it's more like 2 or 3%, but yeah, 2 or 3% is also significant. Yeah. So these are the couple of reasons why Deep Industries felt acquiring these two subsidiaries was important for them at this juncture of their growth journey. Okay, now that we've understood what has happened here, let's redraw the financials. Let's go to the quarterly results. Actually, let me show you where to find this information from. So go down to the latest quarter, tap in on the PDF. Okay, it's a 22-page PDF. Go right down where it says consolidated. Yeah, okay. So consolidated, you can see here, it says there's an exceptional item of 251 crores. This one is in lakhs, 251 crores. So it says refer to note number 9, right? So we refer to note number 9. Let's go down. Uh, this one's 9. Yeah. See this here. For the year ended 2025, March of 2025, your net profit for the year before exceptional items is actually 160. So it did 122 crores last year in FY24, and in FY25 it comes to 161 crores before exceptional items. So when you include the exceptional items, then some minus something, was it's minus 79 crores, but with this, actually it should have been around 161 crores. You can actually calculate it manually also. So the last 4 quarters, it's 39, 42 and 48. So that's 90 plus 39, 129 crores. And here you have the operating profit at 57 crores. So 57, let's exclude this. So 57 plus 6 is 63, minus 3 is 60, minus 11 is 49. Let's apply a tax of, let's say 20%. Yeah, let's knock off 10 crores from here. So it should be 39 crores, right? So 39 plus 39 plus 42 plus 49 comes to 160 something. So yeah, it's pretty close to that 161 number, and that's just a manual check from my end on how things have worked up. The part I want you to focus on is more from a valuation perspective, because now that we have redrawn those numbers, 161 crores, our market cap is currently as 2,700 crores. So let's open a calculator. So 2,700 divided by 161 comes to 16.7. So see, again, there is a small rift between what we think should be, or what I think should be, the actual P ratio, the 12-month trailing P ratio, which I think should be 16.7, while as per Screener, it's coming to 20.2. And different platforms actually give a different numbers. Let's try a couple more. Let's try TickerTape. And let me open one on the side. Let's try Tijori Finance also. Okay, so let's try this out. Deep Industries. We have something, yes. See, it says minus 30 because it's actually taking into account that exceptional loss that also happened. So market cap divided by the exceptional loss, it's giving minus 30. Again, very simple. I think it was 2,700 was the market cap divided by minus was it 79 crores or something. So that gives us a minus 30. Let's look at Tijori as well. Let's do Deep Industries. Okay, yeah, let's look at this. I think price chart valuations. You got the P ratios. See what happened. So from around 1920, as soon as the results came in, the P ratio dipped to 0. Actually, it's lower than 0. So they've just published it at 0. So that's how different platforms would show a different number for something like this. So the way Screener is doing it is, I think it's not taking the exceptional loss or the exceptional profit into account. So when it does the P ratio calculation, it kind of knocks off this particular number, this 251 number. So they knock off this number, and that's how they are able to show a positive P ratio, while the other platforms are showing a negative or a zero P ratio, right? So just understand these variations between different screening platforms. Also be very careful while working with exceptional losses or exceptional profits. There's a lot of dust that's going to be around, and only when you kind of filter it out and see what exactly is the nature of the transaction, whether there's an actual upside, whether there's a downside, is this a actual one-off transaction, or is there some trickery going on, then only you'll be able to make a better sense of whether it's an opportunity for you or whether it's the signs of a forthcoming decline. So be very careful of exceptional items. There's a lot to learn from those. All right, so let's take things a clip ahead. And remember, I'd spoken about deep industries getting into offshore services recently. I mean, they are big into onshore, but offshore is something which is very new for them. And the big catalyst for offshore services was their acquisition of Dolphin Offshore Enterprises India Limited, that they purchased in December of 2022 for some 27 odd crores. This was bought extremely cheap. This was via the CIRP process. They had invested some 110, 120 crores in refurbishing this barge called Prabha. And the latest news is that this barge will start generating revenue from Q1 of FY26. So per the management, an agreement has been inked with a Mexican company for $30,000 a day. So that comes to some 281 crores over 3 years, so 94 crores a year. And the interesting part is that this amount is net of OPEX. Almost all of it will be added to the EBITDA. I'm sure you can do the math. The EBITDA for the company in FY25 was 231 crores. So you add another, let's say 94 on top of it, that comes to 325 crores, which effectively is like 100% jump from where it was in FY24. So that's a pretty decent deal. And remember, the barge, the life of that barge, that Prabha that they have, is actually 15 years. So imagine getting 94 year on year. It might not be 94 all the time because the rates will go up and down. It's a pretty decent deal. It's a very sweet deal that Deep Industries has done for itself by acquiring Dolphin Offshore Enterprises India Limited, which they did a couple of years back. And the way, at least I look at it, is that these guys have a good history of taking distressed assets, assets which are into liquidation, into CIRP, and to kind of do a turnaround with them. So this is a very good example of a turnaround. And if Deep Industries can manage the same thing with this other one, which is Dolphin Offshore Shipping as well, with the tugs, etc., then all this can lead to a much higher EBITDA over the years to come. Again, I'm not giving you any kind of recommendation. Please don't even look at it as a positive statement. I can disclose that yes, I have a few shares of Deep Industries with me, but yeah, please do your own research. That's very important. Another element I would want you to consider is the order book. Please note, some part of this order book, about 1,400 crores, is from a PEC contract with ONGC that will extend for the next 15 years. It starts from this year, so it will extend for 15 years, while the rest will come from the regular contracts that have a tenure of 2.5 to 3 years. This brings me to a concern as well. Client concentration, and Deep Industries gets a bulk of the revenue from ONGC. Now, whenever the management is questioned on this particular part, they tend to say that Deep Industries is the most advanced and the most efficient player when it comes to support services for the oil and gas industry, and therefore ONGC loves to work with them. But I'll still kind of be careful and at least red flag it as a risk in the overall business model. So just like any other company, there are a number of pluses and minuses for Deep Industries as well. But one thing I'll always recommend is for everyone to read the credit rating of each of these companies that you're tracking. These credit ratings give you a fantastic idea as to what exactly are the factors that help the company, and also are the headwinds for the company. And in this case, you can see it's a very good description of what are the strengths of the company, the diversified revenue stream, the clientele, the order book, the growth and scale, in terms of their operations, what's the industry outlook like, and there are also the weaknesses here. So obviously, I talked about the concentrated clientele, with ONGC forming like 49% of the net sales. There are group companies, there are debtor days, stuff like that. So don't work out too much around the rating. That's not the objective here, but definitely have a look at these 3-4 pages. I think there is a lot of information here, and this would really help you gauge and evaluate what this company is really all about. Okay, so with this, I would like to conclude today's video. We talked a lot about deep industries, although that was not the objective of the video per se. It was basically to understand different line items within the P&L of the company and the importance of evaluating exceptional gains or losses in terms of its impact, consequences, and to redraw the financial numbers. Of course, we can find opportunities when we do this, or this can also lead to a change in stance. Our entire investing thesis can change. The more you look at it, this happens all the time. The more you look at it, I think your brain will kind of understand things even better. It'll be able to make the connections, and I'm sure you will have a lot more scenarios like these that will come up. And yeah, please remain curious, remain cautious, and I'll see you next time.